So we'll go to chapter 2 of business AS level, Cambridge. Today's topic is business structure. And when we talk about business structure, it simply implies to the legal framework, which analyzes how a business is being organized and how it's being operated. That's what a business structure is, how a business is organized and operated. So that takes us to the economic sector. And when we talk about the economic sector, we are simply talking about the different classes of economic activities, So here they wrote, business activity and ownership can be classified in a number of ways. One of these is by identifying which type of product or service is being produced. So we have products that are produced through the primary sector, the secondary sector, the tertiary sector, and the quaternary sector. So business activity produces a vast range of different goods and services. It is possible to classify this into 4 broad types of business activity, which I talked about earlier: the primary, the secondary, the tertiary, and the quaternary. So we're going to start with the primary sector. It is the primary sector because this sector extracts raw materials from finished goods. So this is the primary sector. The image on the screen is an example of a primary sector business. Then we have the secondary sector, which is the conversion of raw materials into finished goods, like the clothing factory in China is the secondary sector. Then we have the tertiary sector, which is the service sector, like the hotel in Dubai is a tertiary sector. Then we have the quaternary sector, which talks about research and development. So we go into the balance of these sectors in the economy of different countries varies substantially. It depends on the level of industrialization in each country. And when we talk about industrialization, we're simply talking about a situation whereby a non-industrialized environment or country becomes industrialized. And when we talk about being industrialized, it simply means the economy is working towards the secondary sector. So go to changes in relative importance of economic sectors. The classification of business activity by economic sectors has 2 important features: changes over time and variations between different economies. So the important sector changes over time. So the importance of each sector in an economy changes over time. In Ghana, there's a table for that in Ghana. The primary sector reduced and the secondary sector increased between 2008 and 2019. So it simply means that in Ghana is moving towards industrialization. That is why the primary sector of Ghana is reducing while the secondary sector of Ghana is increasing. So this is called industrialization, like I said. So the relative importance of secondary sector activity sector activity is increasing in many countries in Africa and Asia. So the relative importance of each sector is measured in terms of either employment level or output level as a proportion of the whole economy. So how do we know how important is the economic sector? We get to know the importance of the economic sector through employment or the output level. So we're going to start. Consequences of industrialization. What are the benefits of industrialization? Number 1, total national output, which is the GDP. It will increase, and this raises average standard of living. If a country is moving towards industrialization, it simply means output within that economy will increase. And if output increases, it brings about an increase in the GDP, which in turn will increase the standard of living. 2, increasing output of goods can result in lower imports and higher exports of such products. So if a country is moving towards industrialization, it simply means that the economy will be able to produce more than what it used to import. So as a result of that, import would fall in that economy, while export is expected to rise. And if export increases in that economy, it brings about an improvement in the balance of payment point account. I think the point there is clear. The third one. Expanding manufacturing business will result in more jobs being created. Due to industrialization, which simply means a non-industrialized economy becomes more industrialized. So if a non-industrialized economy becomes more industrialized, that means the manufacturing sector or the secondary sector within that economy has increased. And if that has increased, it simply means that employment opportunity in the secondary sector is expected to increase. That's another benefit of industrialization. And the second to the last one, expanding and profitable firms will pay more taxes to the government. As soon as there is industrialization, It simply means the manufacturing sector of that economy would be making a lot of profit. And making a lot of profit means government revenue would increase through corporation tax. And as soon as government revenue increases through corporation tax, government will be able to increase its own spending on infrastructure, education, and so on. The last one, value is added to the country's output of raw materials rather than just exporting these as basic unprocessed products. Because the economy is producing, it's now converting raw materials into finished goods. It simply means whatever it takes, there's added value. So which simply means there's always going to be a reason for foreign customers to want to buy the country's output or products. So what are the problems of industrialization? Number one, the chance of work in manufacturing can encourage a huge movement of people from the countryside to town, which leads to housing and social problems. The first problem the first setback when it comes to industrialization is that it brings about social problems and housing issues, because a lot of people would want to migrate or move from countryside to where there is more opportunity for employment, and that might bring about congestion. Two, imports of raw materials and components are often needed, which can increase the country's import cost. Because it is about the conversion of raw materials into finished goods, a country that is moving towards industrialization might need a large volume of imported raw materials, and this might increase importation, which might bring about a decline in the balance of payment current account. And the last one, much of the growth of manufacturing industry is due to the expansion of multinational companies, and this can have a negative impact on the economy too. So most of the growth in the manufacturing sector is literally done through multinationals, and it simply means a lot of multinationals will set up in such an economy. And if multinationals set up in that economy, it simply means they become a threat to the domestic companies, and that could reduce economic activity for such country. In developed economies, the situation is reversed. There is decline in the importance of secondary sector activity and increase in the tertiary sector. This process is termed deindustrialization. So in developed countries or in developed economies like the European countries, America, Canada, there is what we call deindustrialization, which simply means a decline in the manufacturing sector. So in developed economies, they are moving towards the service sector, the tertiary sector. So there is decline in the primary sector and the secondary sector. What are the causes of this change? Number one, rising incomes associated with higher living standards have led consumers to spend much of their extra income on services rather than more goods. There has been substantial growth in tourism, hotels and restaurant services, financial services and other services. However, spending on physical goods has risen more slowly. So one of the reasons why we have deindustrialization is that consumers now have an increase in their income, and as a result of that, they spend more on services rather than physical goods. Two, manufacturing businesses in developed countries face much more competition as a result of increasing global industrialization. This driver tends to be more efficient and use cheaper labor. Therefore, rising imports of goods are taking the market away from the domestic secondary sector. Another reason why we have industrialization is that developed countries are now facing more competition with developed emerging economies. As a result of that, they figure out that it is less profitable for them to continue in the secondary sector, because in developing countries, they are able to produce goods and services with cheaper labor, which is not the same as the tertiary sector. So what are the consequences of deindustrialization? One, the consequence of the decline in the relative importance of the primary and secondary sectors and the increase in the relative importance of the tertiary and quaternary sectors are: one, job losses in agriculture, mining, and manufacturing industries. As soon as an economy becomes deindustrialized, there will be unemployment. Unemployment will increase in the primary sector, in the secondary sector of the economy. Two, movement of people towards towns and cities. That will also bring about congestion in cities instead of the local environment. Three, job opportunities in service industries, the tertiary and quaternary sector. So there will be increasing job opportunity. There will be increase in the supply of labor in the tertiary and the quaternary sector, which might bring about a fall in the level of income in the tertiary and quaternary sector. And the last one, increased need of retraining programs to allow workers to find employment in service industry. And the last one is the training cost that will bring about flexibility for workers to be occupationally mobile. So, because if they are not occupationally mobile, they might not be able to work in the tertiary or the quaternary sector. So it simply means firms have to spend more on training, government have to spend more on training, individuals also have to spend more on training to be able to have the flexibility to work either in the tertiary sector or the quaternary sector. The importance of sectors varies between economies. So I'll be right back, please. So we have the public sector and the private sector of the economy. Yeah. Industry will also be classified in other ways. For example, by public or private sector, or by type of legal structure. These two types of classification are interlinked, as some types of legal structure are found only in the private sector. What is the difference between the private sector and the public sector of the economy? In nearly every country, the mixed economy, most business activity is in the private sector. So the relative importance of the private sector compared to the public sector is not the same in all countries. Those economies are closest to a free market system, which have very small public sectors. Those countries with central planning command economies will have very few business in the private sector. So there's a public sector and there's a private sector. And that's another classification of a business. And when we talk about the public sector, we're simply talking about a business sector that is mostly controlled by the government. And we can simply see a higher percentage of the public sector in a command economy. And for the private sector, we're talking about a sector that has the individuals and private firms running affairs within the industries. And mostly we have it in the free market or in the mixed economy. So we have the public sector, we're going to the public sector enterprises. Why do we call it the public sector enterprises? We call it the public sector enterprises because it is being controlled by the government. So let's read. In most mixed economies, countries, important goods and services are provided by government-owned or state-owned organizations, as it is argued that they are too significant to be left to private businesses. These public sector enterprises usually include health and education services, defense and public law, and other. In some countries, important strategic industries such as energy, water supply, public transport are also owned and controlled by the state as public corporations. So, according to notes, he said in most mixed economies, the importance of the most strategic area of the most strategic sector of the economy is controlled by the government in most mixed economies. And when we talk about the mixed economy, we're simply talking about an economy that combines both the private sector and the public sector. So in such economy, the most strategic area, like the provision of merit goods such as education and healthcare, is being provided by the government. Water supply, energy, public transport is done by the public corporation. Another reason for the state or public sector rather than the private sector to provide products is the existence of public goods. These are goods and services that cannot be charged for or so it is impossible for a private sector business to make a profit from producing them. A good example is street lighting. Another reason why we have the public sector providing certain products or goods or services is because those goods are public goods. And when we talk about public goods, these are goods that cannot be charged upon, which simply means the private sector will not be in a position to provide them, because if they do provide them, they won't be able to make profit. The private sector wants to produce goods and services that will enable them or in order to make profit. And public goods are not goods that you can make profit out of. As a result of that, the public sector provides such goods. Example is the street lighting. Another reason for the state and public sector rather than the private sector to provide products is the essence of the public goods, which I talked about now. Also, they said a good example is street lighting. It is impossible to exclude people from obtaining the benefit of street lights, even if they have not contributed to the paying for them. Why should anyone contribute directly towards paying for them? Taxes have to be used to raise revenue to pay for a street lighting system, as light can only be provided by the public sector. Because it's a public good, it is non-rivalry and non-excludable. It is non-rivalry and non-excludable. As a result of that, taxpayers' money have to be used by government to provide street lighting. Public sector organizations do not often have profit as a major objective. In many countries, the main priority of public-owned TV channels is to produce public service programs. State-owned airlines have safety as priority. If public corporations are sold off to the private sector, there will nearly always be a change of objectives towards the profit motive. So for the public sector, they mostly provide goods and services for the well-being of the society. It is not about profitability. But as soon as there is privatization, then the objective will change from services to profit motive. So what are the advantages and disadvantages of the public corporation or public businesses? The advantages, number one, they are managed with social objectives. They are set up based on the fact that they care about the society, and that is an advantage. Two, rather than profit maximization or profit objective. Two, loss-making services might still be kept operating if the social benefit is great enough. Irrespective of making profit or not, they will still be in existence because their objective is for the society. Unlike the private sector, if the private sector is not making profit, they might as well leave the market, and that reduces output within the economy. And the last one, finance is raised mainly from the government. So there's no problem about finance because the finance is done through the government. Then what are the problems of the public corporations? Number one, there can be tendency towards inefficiency due to lack of strict profit targets. Because the public sector does not think about profitability, does not have profit as an objective. That might result into inefficiency. And if there's inefficiency, it might bring about waste of resources. Two, subsidies from government can also encourage inefficiencies. Government will give subsidy. Government will subsidize for firms in the public sector. And this means they don't have any motive or reason to be efficient. And if they are not efficient, it simply means that is a waste of government revenue. That's a waste of government revenue. The third one, government may interfere in business decisions for political reasons. For example, by opening a new branch in a certain area to gain popularity, there might be government failure because government is the one putting money into the business. And as a result of that, they might use it for political reasons, which is not the essence of having such business. Now, we go to business ownership. And when we talk about business ownership, we're talking about the legality in business activity. So what are the type of business ownership we have? We have the sole trader, we have the partnership, we have the limited companies, and the cooperatives. So we're going to start with the sole trader. Why do we call it a sole trader? We call it a sole trader because it's a business that is owned and controlled by an individual. So I'm going to read it. This is the most common form of business ownership. Although there is a single owner in this type of business organization, it is common for sole traders to employ others. However, such firms are likely to remain very small. Because of this, although they are great in number, sole traders account for only a small portion of the total business turnover of a country. So a sole trader is a business that is owned and controlled by individuals and is the most common form of business because it is easy to set up. All sole traders have unlimited liability. This means that the owner's personal possessions and property can be taken to pay off the debts of the business should it fail. So this can encourage some potential entrepreneurs from starting a business, discourage them from starting up a business. Another significant problem is finance for expansion. Many sole traders remain small because the owner wishes to remain in control of their own business. But another reason is the limitation on raising additional capital. As soon as partners or shareholders are sought in order to raise finance, then the sole trader becomes another form of organization altogether. In order to remain the sole trader, the owner must be dependent on their own savings, profit, and loans for injection of capital. So for a sole trader, most of the time, a sole trader has unlimited liability. And what does unlimited liability mean? It simply means that whatever happens to the business, in case the business has debts to pay, the owner of the business might have to use its own personal wealth to pay off the debts. And the problems about most of the time, sole traders do not want to expand. They don't want to expand because they want to keep control. They want to keep control of the business. Another time, they might not be able to expand because they lack the financial capability to expand. Because as soon as they start thinking about raising finance from external sources, the ownership the ownership structure starts changing. So that takes us to the advantages and disadvantages of a sole trader. What are the advantages of sole trader? Number one, easy to set up. Why is it easy to set up? It is easy to set up because it does not involve any legal framework or formality. Two, owners have complete control. So that means the owner is the boss, Does not have, he or she is not answerable to anyone. The third one, owners keep all the profits. All the profit belongs to the owner of the business. The fourth one, owners can choose times and patterns of working. The owner decides the time of opening and the time to close. Owner can establish close relationship with staff if any are employed and customers. So because it's a sole trader, the owner knows the customers and the customers know the owner. So which simply means they can simply have a personal interaction and they get closer to each other. And that is another advantage because you might gain, a sole trader might gain customer loyalty as a result of that. And lastly, business can be based on the interest or skills of the owner, rather than working as an employee for a large firm. A sole trader might be an individual who has a certain craft that he or she wants to make a business or profit out of. So that means he or she can start up a business in as much as he has or she has the skills. So what are the problems of being a sole trader? Number one, unlimited liability, which simply means the owner's assets are potentially at risk. Whatever happens to the business can be transferred to the owners of the business. Two, often intense competition from bigger firms, for example, in food retailing. A sole trader might face stiff competition or fierce competition from large businesses, and as a result of that, a sole trader might be out before a short time. A sole trader might be out of business. Three, owner is unable to specialize in areas of business that are most interesting. Is responsible for all aspects of management. Because it's a sole trader and it does not have the financial capability to employ special skilled workers, it simply means the owner of the business might have to do every management aspect, finance, human resources, marketing, all alone. And he or she might be lacking in some skills, and that might bring about a failure. The next one, difficult to raise additional capital. It might be difficult for a sole trader to raise additional capital. One of the reasons why it might be difficult for a sole trader to raise additional capital is because financial institutions might see them as a high risk. As a result of that, it might feel reluctant to give them loans. Second to the last one, long hours are often necessary to make the business pay. A sole trader might have to spend long hours of work for it to succeed. And last one, lack of continuity, as the business does not have a separate legal status. When the owner dies, the business also ends. So another problem about a sole trader is that the death of the owner might mean the end to the business. So that takes us to partnership. That takes us to partnership. Now, when we talk about partnership, is another type of business ownership. So when we talk about partnership, we're simply talking about a business that is controlled, owned by two or more people. So partnership are formed in order to overcome some of the drawbacks of being a sole trader. It is usual with all partners, although not a legal requirement to draw up a formal deed of partnership between all partners. And when we talk about deed of partnership, we're simply talking about a partnership agreement that binds the operations of the partnership. So that's what a partnership deed is. However, a partner's agreement does not create a separate legal unit. A partnership is just a grouping of individuals that come together with the aim of making profit. When planning to go into partnership, it is important to choose business partners carefully. The errors and the poor decisions of any one partner are considered to be the responsibility of all the partners. So it is important when an individual or group of people are coming together to start up a business, it is important for them to choose carefully their partners, because a mistake of one partner is binding to all. So what are the advantages of, so we said, okay, this also applies to business debts incurred by one partner. In most countries, there's unlimited liability for all partners should the business venture fail. Unlimited liability can act as a disincentive for people to become partners in a business. This can limit the capital that partnership can raise. So, same as a partnership business also have unlimited liability as a sole trader. So what are the advantages of partnership and disadvantages of partnership? For partnership, what are the importance or advantages of partnership? Number one, partners may specialize in different areas of business management. Because it's a partnership, it simply means those group of individuals that have come together to start up a business might have their strength in different skills. Unlike a sole trader that has to do everything together. In partners, they might have different specialties, and that would help the business. Two, they share decision making. Decision making is shared among partners, unlike a sole trader that has to bear all the burden of decision making. Three, additional capital is injected by each partner. There's the tendency of increasing the capital base because each partner would be able to contribute different amounts of money into the business. The next one, business losses are shared between the partners, and there's always also a share of profits, unlike a sole trader that has to bear all the burden of loss on its own. So here the profit is shared, the loss is shared among partners. And last one, there's greater privacy and fewer legal formality than in corporate organizations. Unlike public limited companies or private limited companies, a partnership still has a few paperwork to work on, which means there's still privacy in their operations. So what are the problems of a partnership? Number one, all partners have unlimited liability without exception, with some exceptions. So partners with the debts of the business can be transferred to the personal wealth of the partners, just like a sole trader. There's share of profits. So all profits has to be shared among partners, unlike a sole trader who has to keep all the profit to himself or herself. There is no continuity, and the partnership will have to be reformed in the event of the death of one partner. There's no continuity in partnership because the death of one partner means the formation of the partners has to be reestablished. The next one, all partners are bound by the decision of any of them. So whatever mistake one of the partners make can affect all the partners. It is not possible to raise capital from selling shares. Partners cannot sell shares to the public. And the sole trader taking on partners will lose decision-making independence. And if it was a sole trader now becoming partners, it means decision-making has to be amongst all members. So that ends our partnership. The next one is limited companies. And when we talk about limited companies, we are talking about businesses that have limited liability. So limited liability for owners. The owners of companies is divided into small units called shares. People can buy these and become shareholders. Part owners of the business. That means we have shareholders for limited companies because they are the ones that will buy the units and they become the owners of the business. So all shareholders, what are the benefits of shareholders? All shareholders benefit from the advantage of limited liability. Nobody can make any further claim against shareholders should the company fail. This has two important effects. So for a limited company, there's a separate legal identity, which simply means the owners are separated from the business itself. So what are the effects of this? One, people are prepared to provide finance to enable companies to expand. Because it's a limited liability company, the owners would only lose their personal contribution to the business, not their personal wealth. As a result of that, they may be prepared to take the risk. Two, the risk of company failing to pay its debt is transferred from investors to creditors such as suppliers and banks. Creditors, as a result, are very interested in analyzing the company's account for signs of potential future weakness. Since the transfer of debt cannot be done to the owners of the business, it simply means financial institutions and creditors have to look carefully to check if the business is creditworthy or not. Legal personality. A company is recognized in law as having a legal identity separate from that of its owner. This means, for example, that if the food sold by a company are found to be dangerous or contaminated, the company itself can be taken to a court, not the owners. So what are the features of a limited company? The first one is legal personality, which simply means the owners are separated from the business. Two, continuity. There's continuity in a limited liability company because the death of one owner or the death of the director does not lead to the breakup or dissolution of the business. So we have two types of limited companies. We have the private limited companies and the public limited companies. So we're going to start with the private limited companies. Why do we call it private limited companies? We call it private limited companies because they are small firms that they have created, They can sell their shares within friends and family. So what are the advantages? Number one, shareholders have limited liability. So for a private limited company, the shareholders, whatever happens to the business does not affect the shareholders. The only thing they lose is the money contributed into the business or invested into the business. Two, the company has a separate legal personality. So the business is different from the owners. Three, there's continuity in the event of the death of a shareholder. So the business will not end because of the death of a shareholder. The original owner is still often able to retain control. For a private limited company, the owners might still have control or still take charge of the business by becoming the chairman. The company is able to raise capital from the sales of shares to family and friends and or employees. So for a private limited company, it can still raise additional capital through selling shares to friends or family or employees. The company has better status than unincorporated business. A private limited company has a better reputation compared to a private to a sole trader or partnership. Then what are the problems of a private limited company? There are legal formalities involved in establishing the business. There's a lot of paperwork that has to be done, carried out through the registrar of companies. Two, capital cannot be raised by the sales of shares to the general public. There's still limitation to the amount of capital that can be raised because a private limited company cannot sell shares to the public, to the general public. It is quite difficult for shareholders to sell shares. It is difficult to transfer shares from one shareholder to another. End of year account will be sent to the government office responsible for companies and are available for public inspection. So the financial statement of the company must be published. And it ends with LTD. So that takes us to public limited company. We call it a public limited company because it can sell its shares to the general public. So a public limited company has all the advantages of private company status, plus the rights to advertise its shares for sale to the general public and have them quoted on the stock exchange. This means that a public limited company can raise very large sums of public issues of shares. So the difference between a private limited company and a public limited company is that a public limited company can sell shares to the general public, which means it can sell its shares in the stock exchange. And existing shareholders can also transfer their shares without restriction. So what are the advantages of public limited companies? One, shareholders have limited liability, which simply means that in case of death to the business, shareholders are only going to lose their investments, not their personal wealth to the business. Two, the company has a separate legal identity. So there's difference between the owners of the business and the business. There's continuity. The death of one shareholder does not end the business. The business will be run forever. It is easy for shareholders to buy and sell shares, encouraging investment. So investment is encouraged here because shareholders can as well transfer their shares whenever they feel like they want to transfer their shares. Substantial capital sources can be accessed due to the ability to issue a prospectus to the public and to offer shares for sale. There's always flotation, which allows additional capital to be raised through the sale of shares. So what are the problems of a public limited company? Formation entails legal formality. There's a lot of paperwork that has to be done through the MOA and the AOA. There can be high cost of paying for advice from business consultants when creating a PLC. A public limited company might have to pay a lot of money to be able to get information and consultancy from experts. Share prices are subject to fluctuation, sometimes for reasons beyond the business control. For example, the state of the economy. The price of shares can be fluctuating because of external factors such as such as depression within the economy. There are legal requirements concerning disclosure of information to shareholders and the public. They have to follow up with all legal procedures to ensure that shareholders are not vulnerable, and that might be expensive. There's a risk of takeover due to availability of shares on the stock exchange. And a private individual might take over, an unknown person might take over the company because shares can be sold to external people, even to rivals. Directors may be influenced by the short-term objective of the major investors. Directors might not think about long-term, they might think about short-term, and as a result of that, might be ineffective in terms of longevity. So when there's the legal framework, like I told you earlier, The legal formalities in setting up a company is through the memorandum of association and the article of association. Why do we call it a memorandum of association? Call it a memorandum of association because it's a document that talks about the share capital, the relative importance of the shares itself, what they want to sell, and who they are dealing with. And for the article of association, it talks about how the trading will start up with. Then that takes us to cooperatives. And when we talk about cooperatives, we are talking about businesses that are owned and controlled by their members. So these are very common form of business organization in some countries, especially in agriculture and retailing. It is common to differentiate between producer or worker cooperatives, which are involved with making goods, and consumers or retail cooperatives, which sell goods or services. Certain features are common to all cooperatives. We have consumer cooperatives, we have producer cooperatives, we have retail cooperatives. So what are the features that are common with all cooperatives? One, all members can contribute to running the business and sharing the work, responsibility, and decision making. In larger corporations, some delegation to professional managers takes place. So because it's a cooperative it's a cooperative society, all members can contribute to running the affairs of the organization. All members have one vote at important meeting. All members have each vote when during the meeting. And last one, profit are shared equally among members. Profit are shared equally among members because each member contributes equal amount of money to the cooperative. So that takes us to the advantages of cooperatives. Okay, the advantages of cooperatives. They buy in bulk. That means they can buy in bulk because they can put money together as a result of that. Two, working together to solve problems and take decisions. They can work together and take decisions at the same time. Three, good motivation for all members to work hard as they will benefit from shared profit. So there's always the motive to work hand in hand because there's always going to be a reason to make profit. But what are the problems about cooperatives? One, poor management skills unless professional managers are employed. They are cooperative society, they are members. They might not have the required skill to run the business. Two, capital shortages because the sale of shares to non-member is not allowed. There might still be restriction to the amount of money they can raise in terms of capital because it is restricted to their members. And lastly, slow decision making if all members are to be consulted on important issues. Each member cannot make decisions, which simply means all members have to agree on certain decisions, and that might make decisions to be slow and poor. The next one is franchise, which is the last one. So for franchise, a franchise is not strictly a form of legal structure for a business, but it's a legal contract between a franchisor and the franchisee. So we have a franchisor, which is the person selling the franchise, and we have the franchisee, the business buying the franchise. So this contract allows the franchisee to use the name, the logo, and marketing methods of the franchisor. So the franchisor can then separately decide which form of legal structure to adopt. So that's a franchise, and there's a reception. So what are the advantages of being in a franchise? Advantages of franchise is one. There are fewer chances of new businesses failing because it is using an established. These are the advantages of franchise to the franchisee. One, there are fewer chances of a new business failing because it is using an established brand name and product. The business is unlikely to fail because it's using a logo or a brand. It's selling in the brand name of an established and successful business. Two, advice and training are offered to the franchise by the franchisee. So the franchisee has the opportunity to have access to advice and training the franchisor. Three, the franchisor pays for a national advertisement. Advertising is done through the franchise. The next one, supplies are obtained from established and quality checked suppliers. So the franchisee does not have to buy supplies from elsewhere. The franchisor supplies all the supplies needed and they are of quality. The franchisor agrees not to open another branch in the local area. So there's always going to be exclusivity when it comes to the location of the franchisee. Then what are the problems of franchise to franchisee? A share of profit or revenue has to be paid to the franchisor each year. So whatever profit that is made by the franchisee, part of it has to be given to the franchisor. Two, the initial the franchise license fee can be expensive. The initial amount of money that has to be paid to get the franchise might be expensive. Three, local promotion will still have to be paid for the franchisee. The franchisee might still have to pay a certain amount of money for advertisement. The franchisee cannot choose which suppliers or suppliers to use. there's restriction to the kind of supplies the franchisee can get. So the supplies comes directly from the franchisor. Strict rules over pricing and layout of the outlet reduce the franchisee's control over their own business. The franchisee does not have control over the business. Rules are set by the franchisor. So those are the advantages of franchise to the franchisee and the disadvantages of franchise to the franchisee. So that takes us to joint venture. And when we talk about a joint venture, we're talking about two or more businesses that work closely together to form a new project. So here they wrote, a joint venture is when two or more businesses work closely together on a project. This is not the same as a merger, but can lead to a merger if businesses' interests coincide and if the joint venture is successful. So what are the reasons why we have a joint venture? One of the reasons for a joint venture is that one, the cost and risk of a new business venture are shared, which is a major consideration when the cost of developing new products is rising rapidly. One of the reasons why a business might go into a joint venture is to share the risk and the cost of entering a new business. Two, different companies might have different strengths and experiences and therefore fit well together. Due to the weakness of one firm, that is a strength of another firm might bring about a joint venture. The next one, they might have major markets in different countries and they could exploit this with the new product more effectively than if they both decide to go it alone. Coming together to form a new business based on the local understanding might be productive and profitable than doing it all alone. Such agreements are not without their risks. So what are the problems that could be encountered during joint venture? Number one, style of management and culture might be different, might be so different that the two teams do not blend well together. There might be difference in culture, in ways of operation, and that might bring about conflict. Two, errors and mistakes might lead to one company blaming the other for mistakes. They might have disagreement and errors might bring about shifting blames to one another. And lastly, the business failure of one of the partners will put the whole project at risk. So if one of the business fails, the whole project might be at risk. Then the last note we need to talk about on forms of business ownership is the social enterprise. And when we talk about social enterprise, we're talking about businesses that their main objective is not about profitability. So I'm going to read it. Social enterprises are businesses that aim to make profit in socially responsible ways. Much of any profit is issued to benefit society. So the main reason why they set up these businesses are to help the most vulnerable in the society. Social enterprises do have objectives that are often different from those of an entrepreneur who is only profit motivated. However, they compete with other businesses in the same market or industry. They use business principles to achieve social objectives. So most social enterprises have these common features. One, they directly produce goods or provide services. They produce goods and services for consumers. They have social aims and use ethical ways of achieving them. They do not engage in any illegal, they do not engage in any unethical way in terms of operating or producing their product. They need to make profit or survive, as they cannot rely on donations as charities do. Another point is that they want to make profit, but because profit they make is returned into the business, but they do not make it the same way as other businesses, and they do not rely mostly on donations as charity does. So the last note we need to talk about today is changing the form of business ownership. Most businesses do not change their form of business ownership over time, but many do. The most likely advantage of changing from one form of ownership to another, for example, is sole trader or to private limited company, can be summarized. One of the reasons why this change of ownership is one, access to more finance. A sole trader might want to change to a partnership because it's going to have the ability it's going to be able to have more capital injected through partners. Gaining legal identity. A sole trader or a partnership might want to become a private limited company so that it can have a separate legal identity. 3, protecting owners' capital through limited liability. An unincorporated business might move to become a corporated business so that the owners will not be able to lose their personal wealth in case there is debt. Legal costs and formalities. Some people might want to remain a sole trader because they could not, afford to pay, or they could not afford to pay the amount of money needed or the requirements of becoming a corporate or a corporation. Some loss of control and ownership by the original owner. Some businesses might remain the way they are because they do not want to lose their status. Profit and share. Some private businesses might want to remain private, a partnership might want to remain, a sole trader might want to continue to become a sole trader because it doesn't want to share profit with others. So this ends business structure, economic sector, and business ownership. Thank you.